these latest, uh, uh, you know, uh, pieces of information coming to us in terms of what the impact of this could be on both insurers as well as distributors. You believe that this will be pushed through, because there's been plenty of debate on it. Which side of the aisle do you sit?
Well, I hope it's pushed through from the consumer side, to be honest, because consumers, uh, in general, insurance payouts are substantially higher than most other financial products in terms of percentage of commissions paid, at least in the first year or second year or so on. So that tends to create a sense of, focus among people who are distributing financial products to favor an insurance product where it is possible. Let's put it this way also, that since the awareness is there both at the consumer end and at the distributor end of some sorts, and there are very few products that allow you to say, listen, I will take a lower commission, just give a better deal to the customer. There's no way in easily that a customer can or even a distributor can demand that. It's going to be an across the industry rule, and it's going to hurt any distributor or any broker or any player that earns a percentage of that commission, or that commission itself, down, at least from a cash flow perspective. It may be the same numbers, but it may happen over a period of time rather than a little more upfronting of it, and therefore create different economics for both the employees of the companies distributing it and the companies themselves that are distributing it. Insurers may see lower business because relatively speaking, it takes time for someone to readjust to new and lower commission levels. But by and large, I think the industry will be benefited because of it, not worsened. Because when you do a better deal for customers, eventually more customers come. But that may take 1 or 2 years, and during that time there will be a little bit of a change, and the economic cycle may hurt a little bit more on the distributor end than it is on the company end. Insurance companies are built to last 40-50 years, so therefore I think for them the impact will be a little bit lesser, but the distributors typically have more ongoing cash flow based incentives, and therefore they get affected a little more.
Okay, technical research, wealth management at Motilal Oswal Financial Services. Ruchit, good afternoon. I'll come to you in just a minute, Ruchit. Kunal, your picks for this afternoon. Let me try and close that one out.
So, two buy calls. The first is on Shriram Finance after a correction of almost 40-50 points recently in the last 4 to 5 days. The stock has come back towards a good attractive price point, 965 thereabouts. So, look out for a contra buy at current levels, targets of 997, stop loss at 942. And the second would be about Bharat Electronics. So I think that's a stock which have been bullish on. The stock now trading just around that 415 odd mark. So BEL is something which I'd recommend as a buy. Targets of 434, stop loss at 412.
Okay. All right. Ruchit, let me come to you. It's been a roller coaster of a market, frankly, last 6 trading sessions. How do you view it, and what's the trend that you make of it, and what's your prediction? How's the week going to go by, in your opinion?
Yeah, hi, very good afternoon.
Very good afternoon.
In the last few trading sessions, we have seen that correction from the all-time high that we touched. So I think the most important thing was the breakdown below that 50-day EMA support. When the index, during all the corrections since the month of October, the 50-day EMA was acting as a support which got breached on Thursday. And post that, we have seen a continuation of the corrective phase. So I think what today's move is just because of that oversold setups. But until the Nifty again reclaims that 50 EMA, which is now around 25,900, I think that market would be in a corrective phase. So very selective stocks are expected to do well from here on, at least in the short term. 25,900 is the level where the 50 EMA is placed. So until index shows a sustainable move up about 25,900. I think the index would go through some time-wise corrective phase in this broad range of 25,900 as a resistance and 25,300 to 400 zone as the support. So we do not expect any run-up move on the either side in the index. Some volatility would be there, but a broad consolidation phase, I think, is what could be seen in the short term.
Okay, so that's the take coming in from Ruchit. Ruchit, your picks in this market, how would you play it?
So a couple of names, and we are sticking to more with the large cap names rather than going with mid caps and small caps for now. ICICI Bank is one large cap stock that we like at current levels. Off late we have seen the stock showing a relative outperformance compared to other banks in last 1 week. The price up moves have now witnessed good volumes, so this is a good sign. So we expect limited downside from here on. So short-term traders can look for buying opportunities in ICICI Bank with stop loss below 1380 for potential up move towards 1490. And Tata Steel is another large cap name that looks positive technically. In fact, if you look at steel stocks such as Tata Steel, SAIL, even JSW Steel, it just seems that post an up move, the stocks witness some consolidation and are now geared for the next leg of uptrend. So I think irrespective of market move, these are a couple of heavyweights which can do well. Tata Steel, the 20 MI is acting as a support, so one can go long at current levels with stop loss below 176 for potential up move towards 190.
So those are the picks coming through as well for you. Deepak, let me come to you with regard to DMart. Now, that as well as, let me try and broad base it. I know you don't talk stock specific. Let me talk retail as a whole. What's playing out? Top line growth isn't matching expectations. Multiples are elevated. Gross margins are expanding, which is causing positive traction both on EBITDA as well as on profitability. So the surprise on EBITDA and profitability has been better than what one would have penciled in. Talk to us about how one should look at the numbers, or what plays out in your opinion in terms of numbers in Q3 FY26 overall within the retail pack, and whether you would play it or not, because multiples clearly stretched. So would you play it through value retail? Would you not play it at all? How should one look at this?
So I think two parts here. I think one thing that worries me in a competition intensive sector like retail is the multiples. The multiples are high. There is a tremendous amount of there's in general an overall eating up of margin through competition, and therefore either you lose growth or you can increase margins. It's not it's one or the other, and they've kind of seen one happening in the sense of margins have grown and at the cost of overall growth of the sector. So in my view, what happens is that a lot of competition that's coming into quick commerce and some of the online players spreads the purchasing behavior across multiple players instead of having just one or two. Therefore, any individual player sees a lower growth number, but the overall industry still tends to grow. But at the same time, because your growth factors are, you're losing some of your customers who are buying really small things, and the margins in those small things were also tiny. You are effectively expanding margins on the other products that people are coming to your store to buy. So whatever, let's say, if a store was selling both groceries and electronic equipment, just as an example, but you had higher margins on electronic equipment than groceries, and they move their grocery purchases to someone else. Groceries have much lower margin, so you tend to have a margin expansion because more people are buying. The remainder, the percentage buying electronics are higher, but then overall growth is lower, or you sometimes have negative growth in terms of volumes, in terms of actual sales, but your margins expand. This is not useful for a high multiple. A high multiple can only be justified by growth. Eventually, you have to show growth and stable margins. And I think that is the worry here, is that the industry may be looking a lot more at growth from the perspective of or maintenance of margins, and not really focusing on bringing more value to consumers, which is why perhaps at some level this kind of ride will help the retail industry as a whole, but not any individual player from their economics perspective. And therefore, I would need lower valuations to justify my risk in this.
Okay, lower valuations is the call across the board, or higher growth. We'll wait and watch as to whether either of those play out. But what we'll do is slip into a very short break, and we'll continue coverage here. We'll continue to talk stock specific. We have with us Kunal, Ruchit, as well as Deepak. Stay with us, and we'll continue conversation. sense, hospitality. Warburg's betting big with regard to hospitality. Are you also seeing signs of this cycle continuing with probably a renewed vigor?
I think the hospitality sector should actually do really well. There's a bit of capex that has to come now in the next 2 or 3 years, and that capex is going to drag operating margins to some extent, but also cash flows to another extent, and debt-related changes in many of these hotels. Now, going asset light at a time when asset expansions, some of the other players are going down the asset owned route, may not necessarily be useful in the longer term, because I think portfolios will change, at least from the hotel sector. The portfolios will change more towards developing properties. I think eventually owning properties will be a better way to go in India at the moment. So some of the larger, more premium hotel chains are quite interesting. The smaller ones, I think the competition there is intense. There's a lot of unstructured competition as well. There is a fairly large amount of availability in India. The availability structures have changed in the last year or so, and you're not seeing that much growth in the non-premium segment. The premium segment is growing very well. So I think that's where the focus has been. The hospitality sector in general should expand a little more if we're getting into pleasure cruises, for instance, and few other places, few other sectors in the tourism areas, and we will see a lot more. We will see a lot more happen in terms of capex expansions. So therefore, I am a little wary of paying too much, but I think this is a good sector to have for the next 10 years. It will grow quite substantially from here. There might be times to buy some of the smaller players also. I think they've come down in valuations, but not down enough. They will be. There's a good time. I think you can, kind of, if you think of an SIP into the sector, this is a good time to do it, because I think there will be lots of opportunities that will come in the next year or so to be able to make bets for the longer term.
Interesting. And Deepak, if I were to request you to pick one sector or segment which you're most bullish about in calendar year 2026, what would it be?
I suppose I can't, favor, because I don't know what will happen. But if you ask me, the manufacturing sector in general, specifically around electronics, that still seems to be the biggest bet. Defense, I think, is going to come back in a very big way. We'll have to address some issues. We'll have to address government finances. We'll have to see how the budget comes out. But I think that is another big sector. The third one is financial infrastructure. So I think India is doing very well on that in terms of domestic participation in financial investments and insurance and payments and even in lending. I think financial infrastructure players will do very well in this year, but they're like a little bit further down the cycle here, because we've had 2 or 3 good years behind us. There may be some period of consolidation before the next move. However, I still think they're a good, they will perform well in 2026.
Thank you so much, Deepak, for joining us, giving us that perspective. We'll let you go on that note. And thanks so much for coming in and speaking with us. Kunal, if I were to ask you what's playing out in markets at this point, we're 100 points higher on the Nifty, which is a positive. From the lows of the day, of course, we've done extremely well. I don't think too many people would have called the kind of move that the Nifty has made.
Absolutely.
But we're not seeing that in broader markets. Is that a concern at all for you?
No, it's not a concern. And Harsh, as I was pointing out earlier, that today in the first couple of hours, there were stocks which are down 4%, 5% on an average. Now, for these stocks to even come back into closing flattish negative, maybe a 1% down, I would still believe is a very good sign of a recovery on the overall market breadth. We were almost at 500 towards advances and 2,500 towards declines. We are almost at 1,200 advances right now towards 1,900 declines. So it depends on what matrix you are looking at. If you're looking at this on a relative basis, then of course we've done very well. If you're looking at this on an absolute basis, then of course there'll be some scope of disappointment that the markets have gone through a third or a fourth consecutive day of a negative market breadth. I choose to do it on a relative basis because today the first couple of hours have been completely different than the next follow-up couple of hours for the markets. We've seen a very good recovery, a solid base which is now established at the 25,500 levels for the index. Remember, we are just, I think, 100 points off from 26,000 mark in futures. So that itself tells you the kind of scope of recovery we've seen on intraday basis. So I would believe that it's a very good recovery, should have more legs on the upside.
More legs on the upside, very good recovery. Ruchit Jain, I know you're bullish with regard to Tata Steel in particular within the metals pack. Anything else within metals that's standing out? Do you believe that the whole pack is set for a rally, or do you believe it's a Tata Steel specific call that you've made?
I think the steel related names would do well, be it Tata Steel, Steel Authority, or even JSW Steel. This is one space which relatively is yet to see that catch-up move compared to the other base metals that we have seen. So I think SAIL would be another stock. If one has to create fresh longs from the metal space, then one can go long over here.
Okay, so SAIL and Tata Steel. Ruchit, stay with us. Viewers, stay with us as well. Ashi Anand is going to join us on the other side of this very short break. We'll continue conversation here on ET Now.
EU
Welcome back. Joined by Ashi Anand, founder and CEO at IME Capital, and he's joining us this afternoon to give us his views. Ashi, this rally in metals that we're seeing, if I can call it that, at least today, but even when we look at the last 12 months, metals have been outperformers. Now, whether you call it base metals, whether you look at the steel pack, all of them have outperformed in significant fashion. If I even look at Tata Steel over the last 12 months, it's done very, very well for itself. And Nifty 50 counter, not a base metal either, not linked to a copper, not linked to some of the others. Your sense with regard to the rally in metals and whether that's sustainable or not?
Yeah, sure. So actually, metals is really quite broad, right? And you really need to kind of break up kind of metals into precious metals, some of the base metals, and even within base metals, kind of there are different underlying kind of demand drivers for steel, for zinc, for copper, etc. So just kind of looking at each of these independently, I think what you have seen in the precious metals pack, and this is kind of gold and silver, where you have seen substantial up moves and were probably the big outperformers in terms of an asset class last year. This has really moved up largely on account of kind of geopolitical kind of concerns. And I think a very large amount of this move does appear to be done. In any very strong bull market, it is always very difficult to kind of call the top of a bull market. And some of the underlying kind of demand drivers as geopolitical kind of concerns, the fact that central banks are wanting to kind of increase gold holdings to de-risk away from the dollar, the fact that there is increased investor appetite. Very often towards the end of a bull market, you don't really see as in you still see very strong demand tailwinds. So I kind of like on gold and silver, we are aware that there is extremely strong momentum, but we are kind of a bit more cautious because you've already seen a very large part of the move. So I kind of gold, silver, you're a lot more cautious out there. When it kind of comes to metals, we are a little more positive on certain materials that go into kind of electronics and electricals. So things like copper, some amount, to some extent, aluminium, zinc at some level. What you are seeing is very, very strong AI capex that is going to come in over the next decade. And for a number of these metals, there is an incremental kind of a driver that this is adding, and they are kind of supportive of AI capex is kind of quite supportive of incremental demand generation out here. Not all metals are as kind of favorably positioned there, and which is where you need to look at them individually, as well as there are certain very important underlying kind of supply dynamics. Copper has seen very significant mine shutdowns, which has led to this very sharp rally that you've seen. As those mines come back, you should see kind of copper settle down a bit. So kind of we are a bit more positive on this set of metals where there is this longer term AI kind of demand driven growth. Steel is something we are a bit more cautious about. Steel still it's still very infra or kind of auto or consumer goods or housing kind of driven. The biggest market, which is China, you aren't seeing very strong demand growth drivers coming in from there. Now, until you don't get a lot more positive about the Chinese economy, we kind of see steel have a bit more of a cautious view on the steel pack.
Okay, so that's the take, in fact, coming with regard to metals. Thanks for that, Ashi. I wonder, Ashi, if you also have a view with regard to IT, because that's the pack which will be in focus on the back of earnings. And you have a very keen eye on ground with regard to technology as a whole. I wonder how you're seeing the entire evolution of the IT space as AI kicks in a more significant fashion, and is more broad-based now. How should the IT companies actually catch up? Who will the differentiators be? Who will the winners be? How should one identify that?
Okay, sure. So let's first differentiate IT very clearly into very distinct segments. One, you have digital platforms or tech plays, which are actually apps or platforms that have been created for the Indian consumer. This, as you'll be well aware, we've discussed this multiple times in the channel. We believe that this is the theme for the decade. We have a fund which focuses exclusively on the space. This was launched in February 23, done incredibly well since then. But we still believe that we're still in early stages of this larger structural move. This decade is likely to see sustained kind of value migration away from traditional businesses towards new age digital tech firms. And as kind of these companies continue to scale, we also see profitability and cash flows improving substantially. And this combination of kind of growth as well as kind of improved profitability is really a very, very strong recipe for value creation, and which is what makes us so bullish on the digital tech space. Now, if you're looking at IT services, that is actually quite a different story. IT services being the traditional IT companies like your Infosys and TCS, which are servicing global IT demand. Out here, there are two or three factors which are all quite important to look at. In the near term is firstly what's happening in terms of a demand recovery coming in from the US. Tech spends or IT spends from the US have been fairly weak over the last couple of years. You are expecting to see kind of an improvement as the economy starts to kind of come back. So that is kind of the key near-term driver. However, the moment you're looking at IT services, understanding the impact AI is going to have in the space is very, very important. There are two key impacts. Firstly, as kind of AI becomes a bit more mainstream, we are expecting fairly large enterprise-wide AI kind of projects coming in, where larger enterprises are trying to incorporate AI into their overall kind of tech stack. We see Indian IT companies being very well positioned here, and as you go into FY27 and 28, this should be quite an important, interesting incremental kind of demand driver. You still probably 2 to 3 quarters away from this being substantial, but we clearly see this as an interesting tailwind. On the other hand, AI is also going to be used quite substantially by these companies in order to increase the productivity of their labor force.
Right.
Now, because they need to pass on some of these cost benefits to the clients, this is likely to have a deflationary impact. You're therefore likely to see revenues possibly not grow as much, but improvement in margins.
Sure.
And therefore, profitability should be decent.
Sure. Okay. All right, Ashi. We'll pause there. Ruchit, Kunal, will come back to you straight after this break. What we're going to do is quickly that's likely to play out. So plenty of action this evening and impact of that tomorrow. Ruchit, let me quickly take a view from you with regard to the IT pack. Would you at all play within any of those names within IT? Is that something that you're actively looking at? Anything looking attractive on charts at this point?
I'll wait for the numbers and the reaction of stock prices to the numbers. We have often seen that the quarterly numbers, set out the momentum for the next 2 or 3 months. So I think given that the IT space has recently seen more of a time-wise correction or consolidation, any momentum post the numbers will give more clarity as how the short to medium-term trends would set out. So I think post numbers itself, one can look to create new positions.
Wait for the numbers to come. Kunal, would you also recommend the same? Wait for numbers?
Yeah, see, logically, of course, you'll have to wait for the numbers because you don't know for sure that which stock would be an outperformer. But you also have to look at a point where the IT stocks will sooner or later go into a turnaround. The underperformance which was there for major part of 2025 or the first, I think, 3 calendar quarters, if I can speak. So for the IT stocks, that turned or that started to show signs of turning in the fag end of 2025. So I, for one, believe that maybe there may not be a significant room of disappointment for the stock price, but for the stocks to move up higher, they would need to deliver returns which could be a little bit more above the market expectations. Only then you can expect a meaningful turnaround. I would actually believe that this could be a good zone where large cap IT stocks may be considered as a good turnaround space. So if, for example, if the numbers say slightly disappoint and the stocks are off by a couple of percentage points, I believe that's a fantastic opportunity for someone who has a time frame of at least 3 to 4 quarters or more to chip into these IT majors.
Okay, interesting take. Kunal, I also wonder what your take with regard to Asian Paints is. This has been a stock which has shown remarkable resilience last week, and now, given the rally in the index, we've seen a 2.6% move on an Asian Paints today. What next?
I'm very bullish on the stock, Harsh, and for multiple reasons. One is, of course, the stock being a huge underperformer. First, in the last 2-3 years, 2021 or 22 is where the stock had topped out at 3,500 mark. Took almost 3 years or 4 years for the stock to go into a correction. So a completed time-wise, price-wise correction came back towards 2,300 levels and now start to show signs of recovery. And we've seen historically that when stocks retrace almost 50% of the entire correction they have gone through in a period of the last 2 or 3 years, the scope of recovery on the medium to long-term charts improves significantly for these names. So on the back of this, on the back of recent recovery, I would believe Asian Paints could be a good turnaround candidate from current levels. And I won't be too much perturbed also about the oil price hike for oil price rise if it happens over the near term, because I believe major part of the pain for that has been factored into Asian Paints. So I think even that may not play a dampener for the stock price. So bullish on Asian Paints and expecting the stock to go into a major multi-year uptrend starting maybe previous quarter.
Ruchit, Coal India. By the way, the subsidiary of Coal India, Bharat Coking Coal, the listing has seen a frenzy in terms of the IPO itself is now 25 plus times oversubscribed. Ruchit, with regard to Coal India, I mean, you've seen a surge in the stock price since this announcement. In fact, we've seen a remarkable uptick with regard to the stock price. What next with regard to a Coal India on charts?
Well, this breakout which happened on 23rd of December was a breakout from about 1 year of consolidation phase for Coal India. And post that move, if you look at the volumes, then the volumes have increased gradually compared to what we've seen in the last few months on a daily basis. So I think this clearly indicates that the stock has shown signs of a renewed uptrend after this time-wise corrective phase. On the higher side, considering that the stock is also forming a bullish flag pattern on the daily chart, it has potential to head higher towards 455, 460 kind of levels in the near term. So definitely the trend remains bullish. Any existing longs should be held on for potential targets around 460.
Okay. Ashi, within the IT basket, how would you play traditional IT?
So I think the main thing is, firstly, we do need to see the results. I think as important as the actual results are going to be what management commentary is. We kind of prefer, just given where valuations are, we see a lot of value in the mainstream large cap IT. So both Infi and TCS are both very, very attractively valued. We are aware that mid-size IT may have higher growth potential, but from a value perspective, we find both Infi and TCS very compelling. I think the other element around traditional IT services is the whole ER&D space, which has been under pressure for the last couple of years because of kind of just slightly weakness, some amount of weakness in even kind of EV, ER&D demand. Unlike traditional IT services where levels of penetration is a lot more, I think there's a multi-year penetration story that is to play out in ER&D services. And therefore, from a slightly longer term perspective, we find ER&D a little more attractive than traditional IT.
Okay, ER&D over traditional IT. And Kunal, the move on PFC, REC, IRDAI, that entire pack, has that caught your eye, and would you at all bet on any of these names?
Yeah, we were discussing in the morning about PFC and RSC. I maintain that these stocks are worthy of being part of your longer-term portfolio. So I think it comes as a good move that these stocks are up 3%, 3.5% broadly so far today. I also believe that the recovery that these stocks have shown from their December lows, 330-ish thereabouts, respectively for both PFC and RSC, and the recovery post that towards 380-ish kind of a zone. I think it was quite a class recovery for these stocks. And this is where I would sense that long-term uptrend will start to shape up quite well. And remember, I think for the last 5 quarters, these stocks were into a downtrend. So you can't have a point where these stocks may keep on underperforming quarter after quarter. And if there is a scope of recovery for these stocks, it may not be a meager recovery for these names. So in whichever way we look at, I think over the next 3 months to 6 months at least, there could be a very strong scope of a recovery for both PFC and RSC. I'm very bullish on both of these names.
Very bullish with regard to PFC, REC. Okay. We caught up with, in fact, Manish Garg, CEO of Interarch Building Products, to understand how volume growth is set to outpace turnover, and that's driven by expansion of new plants. Listen in to a slice of that conversation. Stock up 6%, by the way.
If you see, our volume growth has been a bit higher than our turnover growth. So turnover growth really depends on, quite obviously, your volume growth, but then also on the steel pricing that plays out. So in terms of our installed capacity, we are definitely utilizing much more of it. We are ramping up very, very quickly on our new plants, which is the expansion that got commercialized in our Uttarakhand plant with a new capacity addition for the box line. And in Andhra, where we commercialized the phase 2, which is very fast ramping up. So yes, the volume growth is going to be a function of our capacity utilization going even beyond 88 to 90% during the H2 of this financial year.
Okay. Ashi, I wonder how you play some of the hard infrastructure names. Would you play through prefabricated infrastructure like an Interarch? Would you play it through maybe a different manner of playing it? How would you play hard infrastructure, and how would you play real estate? Give us a sense of that.
A little more positive on real estate over hard infra. I think on hard infra, one important element to understand is that the government is shifting a little focus back towards revenue expenditure. What you did see over FY23 and FY24 is kind of capex significantly kind of outpaced revenue expenditure. But post kind of the last general elections, you have seen the government starting to kind of prioritize consumption and kind of pleasing the consumer a bit more. Now, in an environment where kind of you've had income tax cuts, you've had GST cuts, etc., we're not sure on the sheer quantum of kind of growth that you're going to be getting off an already high base in hard infra, and which is why we are not as optimistic here as, say, we were a couple of years ago. On real estate, while the stocks have also moved up quite substantially from effectively their lows, we do believe that you're still kind of somewhere in the mid of possibly a multi-year growth revival cycle. You have multiple underlying kind of strong demand trends. You have kind of consumer demand. You have a shift away from unorganized to organized. COVID has actually led to much higher aspirations in terms of the quality of houses that people want. And all of this is kind of playing out quite favorably in favor of listed real estate companies. So I think real estate is kind of our favored way to play the kind of overall fixed capital formation in the Indian economy.
Okay. All right. Ruchit, let me ask you a quick take with regard to the pharma basket. Is there a view you have there? Is there a tilt? Are there some stocks which you're keeping on your radar?
I think selective stocks can do well where there is a higher top, higher bottom structure. And one of that stock from the pharma space, which we have even recommended to our clients, is Alchem Laboratories. Irrespective of what last couple of trading sessions we witnessed a broader sell-off, we did not see any kind of selling pressure coming in this stock. And with just a minor momentum turning positive, the stock has shown a good outperformance. The stock is even touched its 52-week high today again. So price volume action seems quite bullish over here from a trading perspective. One can go long on Alchem Lab at current levels with stop loss below 5,770 for potential targets around 6,000, 6,050.
Well, thank you so much, Ruchit, as well as Ashi, for joining us. We'll let you go on that note. And as we start wrapping up, the Nifty IT index has